Hi folks, Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational next economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy. Cathy, welcome to the show.
Thanks, Ryan. Glad to be here.
So, Cathy, tell us your social impact origin story. I heard a version of it on a different podcast, but in particular, I know your story involves growing up in inner city Philly, meeting the co-founder of Sesame Street, and working with Fred Wilson, the famous venture capitalist who runs Union Square Ventures.
Yeah, all of those things are true. So the quick version of it is that I early on I was an inner city public school kid, and I had the great pleasure of working with my father, who in some ways was a social entrepreneur, although I don't think he or I even knew the term at the time, who was working across the street from my high school in Philadelphia. He was a professor at the Community College of Philadelphia and taught English. But in the summers, he created programs for high school students who were unable to get into college to develop some of their skills. And he had cajoled a bunch of his colleagues to give their time over the summer to run different classes. And what was interesting to me was realizing in helping him, he invited me to help him and to kind of become the administrator. I was a cheap labor source for his program, and realizing, what it takes to actually have a goal of something that you're trying to change, and in this case, these kids' futures, but that you have to actually run an organization to do it. And so, a beginning epiphany to me of how you have to be, you have to do both. You have to have a goal that you're trying to achieve, and then you have to figure out a means to get that done. And fast forward, I went to college and then started to do some work in Washington, D.C. in policy. And the Sesame Street connection is that I was interviewed. Actually, I had a boss at the Aspen Institute who tossed my resume into a pile while I was on vacation. I think he was trying to get rid of me, to a foundation job in New York. And he said, you really should do this interview with the president of this foundation. And I didn't know who he was or what he did. But I ended up having lunch with the president of this man who was running the Markle Foundation at the time in New York. And turned out over lunch, he revealed to me that he was the co-founder of Sesame Street. And I almost fell off my chair because I was born in 1968. Sesame Street came out in 1969, and I was an inner city kid who used Sesame Street along with my very educated parents to learn to read. But I knew that almost everyone else I knew had also done that. And so I thought, oh my gosh, what an amazing accomplishment to have devised a program in an organization that could touch this many people. And he explained to me how that was exactly the idea. They were trying to figure out how to use the power of mass media to reach inner city kids where it was very expensive to reach them through live Head Start programs. And the government was, finding a lot of problems in doing that. And so it was really a leapfrogging strategy of how can we use the power of advertising and television jingles to engage kids. And so I was hooked, and I ended up working for that foundation in New York for almost a decade, and learning about what entrepreneurs were, and then slowly finding people in the rest of the field, both in the foundation world and the entrepreneurship world, who were thinking about blending those two things. And I became really fascinated. And I ended up going to Columbia Business School, getting an MBA before the term social entrepreneurship existed there, and then kind of came out saying, I really want to think about how to invest in people doing this. And I went to all sorts of conferences. I went to my first social venture network conference in, I think, 2000, and said, oh my gosh, here are all these people just like, who have the same bug. How do I do this? And I ended up meeting Jerry Colonna first, actually. Jerry and Fred Wilson were partners at the time at a firm in New York called Flatiron Partners, which was one of the most successful internet venture capital firms at the time. And I met Jerry through a nonprofit board, and he said something that I will never forget. He said, I don't want to be known for being rich. I want to be known for doing good. And right now we're making a ton of money, but that is not going to make me whole. What can we do? And I said, well, you could start an investment fund that focuses on businesses that do good. And he said, that's really interesting. So that's what we did. And that was the experience that I had with Fred and Jerry in New York. We started a fund. At the time, it was called a double bottom line fund. Today, it would most definitely be called an impact fund, and a foundation. And so we could do nonprofit and for-profit investing. And I've been working with social and impact entrepreneurs and impact investors ever since.
Yeah, I like to think that you were social impact before social impact was around. So that's
a lot of people were. I mean, this is the thing, right? We talk about it now. This stuff has been going on forever. And actually, one of the best books on this for people who care about history and how things start is David Bornstein's book about social entrepreneurship, where he talks about Florence Nightingale as one of the first social entrepreneurs and people who see disruption and see possibilities to have better impact within systems. It's a fantastic book.
Great. Speaking of good books, The Impact Investor, tell us, it's very interesting. The sort of 3-year study you did when going to the limited partners behind these funds and asking how well they did in terms of social and financial performance, and then culling the names down to the funds that were the highest performing funds. Can you tell folks, what was the sort of impetus behind this book, and what were some of the key results you found?
Sure. So this was, a project that we started, I guess, 3 or 4 years ago now, when impact investing, the term of impact investing, was starting to be used very broadly. The Global Impact Investing Network had formed, and they had started, looking around to see what kinds of funds, were using this term and could be thought of as impact investing funds, and even started a database. I, of course, started a database 10 years ago. It had very few people on it. Now it's much larger. But when you went around to people and said, does impact investing work? People didn't know. And I thought, well, that's a really important question. I don't think this field is going to grow if we don't know this, and if we don't start to discern, some of the ways and practices that actually correlate with success. So we decided to, kind of figure out what are the funds in the world that are working. And we could have studied enterprises, we could have studied consortia, we could have studied governments. We decided to look at funds, because funds are, whether they're venture capital and equity funds or whether they're debt funds or whether they're other sorts of things. And we did find some interesting alternative models of what a fund is. They have an organizing function for capital where investors, agree with an investment thesis, buy into what they're going to get back for that, and if it works, they give more. So we kind of looked at this as the canary in the coal mine, and if funds are doing well, this whole ecosystem and notion of impact investing will probably succeed. And if they're not, we want to know, and we want to know why. So we went out into the marketplace, and as you said, we kind of copied another research project that's been in the marketplace for a while. There's another really great book called Forces for Good, which looked at high-performing nonprofits about a decade ago that our center was involved in. And so I had that in my mind. And I said, well, let's do the same sort of thing. Let's go out and try to figure out who people think is good. So we asked, I think, 30 to 50 limited partners around the globe who had put their money into impact investing funds, basically who's great. Now, this is not a statistical way of doing this, right? So this is, a little bit outside the normal research norm, but we said, who do you know that has met or exceeded your expectations, both on financial return and on social return, and in some way that you can define and they can define so we can make sure that it's happening. And so from that, there was a universe at that time of about 300 funds that were listed on Impact Base, which is the GIN's database of impact funds. We ended up having about that number of funds that people that we put in front of people. There were about 50 that people said over and over that they're meeting or exceeding our expectations. And then we kind of looked a little deeper and narrowed that down to 12 based on the kind of data that they collected and their willingness to be part of the study, and also some diversity. So these are not the only 12 high-performing funds by any sense. There's probably 30 to 50 that were at that time high-performing. But what we did notice is that many of the funds in the space were very young. And we were only looking at funds that had a track record that we could demonstrate. And so, if they're 5 years into an equity fund and they didn't have any exits, they were disqualified from being in our study. We were looking at people who had actually shown that they could return the money and the impact.
Right. And you did find, I think some of the results were, pretty good returns on some asset classes. And, what's particularly interesting is the balance between the social debt funds, when you found a 0 to 3% return, and folks saying, oh, is this too small is this not a sufficient return? But I think you had some interesting points about what you're targeting. Could you talk about the difference in market rate and concessionary and what you found?
Yeah, it's really interesting. So what we tried to do, and again, it's comes back from this definition. We said you are a successful fund if you meet or exceed your investors' expectations, period. Right? As opposed to trying to figure out, is this fund, what's the benchmark for this particular fund? And there are some funds where you could create a benchmark. There are a lot of funds that have some sort of investment thesis that no one else has had. So the idea of benchmarking somebody who is investing in financial inclusion businesses in Bangladesh against a regular private equity benchmark made no sense to us, right? So what we did was we said to the investors, or we looked at their investor documents and their original placement memoranda and said, what was the intention that you laid out that you would accomplish with this money? And if you met it, that is a market rate return because you are meeting the expectations of your market. So that is very different than, market rate versus concessionary. The truth is that then if you overlay some of the expectations of the kind of asset classes that we were looking at and the kinds of returns that people were targeting, we were able to divide them into people who were, using equity to do things in developing markets, people who were using debt to do things in developing or developed markets, and then some people who are in, much more lower interest rate debt products and doing things that were either, completely marketable or completely seemed very risky. We also discussed, this whole notion of return, we were really, really careful to redefine a little bit. And I'm actually still very proud of that because I feel like what we uncovered was that there is a set of funds who are able to move people's perceptions across a marketplace where they start out with an investment thesis that no one believes kind of off the top of it that they're going to be able to succeed, and then they prove them wrong. And honestly, someone believed it because they got a little bit of money to start. But what we saw over and over was funds that started with a very small fund. They were able to convince a few pioneers that their investment thesis wasn't crazy. Then they were able to start to show some track record. Then they were able to raise a second fund and a third fund. So a good number of funds in our study were on their third or fourth fund. So they had tremendously stable track records, and they were able then to, really turn people's heads around about the perceived risk of the kinds of theses that they had. We also had some funds, and I love talking about these. We also had some funds that are in that social debt category who, kind of completely turned expectations away from the norm of what you think of as a market rate fund. So for example, one of the funds in the study was RSF Social Finance, which has been around for a while. They run $100 million or so debt fund that invests in the capital needs of social enterprises in a bunch of different areas, in health and education, the arts and agriculture. RSF has a unique relationship with their investors where every quarter their investors meet with the entrepreneurs to have input into what the interest rate should be that they get back from their investment. So they are actually in real time deciding, should it go from 1% to 2% this quarter? Or should it go down? And they are face to face with the people that they are investing, that their money is going to, with the borrowers, to basically say, this money is either going to go to you, it's going to go to us, or it's going to go to RSF. It's going to go to one of those three places, and it's completely transparent every quarter which one of those is going to make out better. And I thought that was amazing, an amazing kind of play on what does it mean to be an investor. It means that you are actually making decisions about who is going to benefit from your capital and for what purpose. And at the time that we did the study, interestingly enough, the investors had said, we want our returns to be lower because the recession is hurting these entrepreneurs and they need the money right now. So their return was actually less than 1%, but they were the happiest investors of anyone we talked to.
Incredible. Would you say that, so how does RSF or, because the 0 to 3% return for, say, someone like CalPERS or a limited partner that maybe is not, are they raising, how are they proposing or like presenting that as an investment that is interesting to limited partners?
Yeah, so the question then is, who are your stakeholders, right? And what kinds of investment theses attract different stakeholders? For the most part, RSF has individual and small family office stakeholders, people who can make their individual decisions without the pressure of managing large pots of other people's money, which is what pension funds do, to decide where that is. But there are other funds in the study that do have institutional capital and that, return 2 or 3%. And when you talk to those investors, which we also did as part of our study, as part of our study, we did a 360 kind of interview process with different limited partners in the funds, with the fund managers themselves, and with the investees to kind of see what was special about each fund. And when we interviewed, for example, the limited partners of the Calvert Foundation, which is another fund in our study, they said, you know what? This is better than any of my cash investments. This is better than a CD. This is better than my bank account. It's returning more, and I get impact on top of it. What's not to like?
Right, because the impact is the blended objective. It's not just the 2% return on your money. It's the impact that you're creating.
It is, but they were also telling us something. They were saying the duration and risk of this capital is actually equivalent to cash. And when I compare that to the rest of that asset class, even on a financial basis, there is no loss. Right? So if there's no loss compared to the alternative for your money, and there's the additional value of knowing that your money is going to women and poor people all around the world, which is what Calvert Foundation does, they were completely satisfied and happy. They thought that they had found a great deal.
And you mentioned in the book that 4 patterns come up repeatedly. First, impact DNA, having impact written into the DNA of the company. Second, having different stakeholders, so getting a lot of different types of folks involved, whether it's foundations or institutional investors. I'm interested, the third and fourth, third is catalytic engagement, so layering the investment with an anchor who's a catalytic sort of gets the fund moving forward, and then the team. So having a mix of skills on board. With catalytic engagement, how did investors attract that initial anchor or that initial catalytic engagement that got them to the fund off and running?
That's a great question. So the pattern that emerged, that you described very well is that for many of the funds and for many of the individual deals that the funds are making, they did not attract just one kind of capital. They were able to attract several different flavors or layers of capital. So maybe there was a commercial player. So I'll give you a specific example because it'll make it easier to follow. One of the funds that we looked at was a Deutsche Bank microfinance fund, and Deutsche Bank was trying to show that you could invest in microfinance and that you could attract commercial players to earn a commercial return. But they went to the commercial players and they said, we're not sure that this is really going to return this money. We're not sure that we trust that poor people are going to be able to return their loans. We need to see more evidence of that. Or we need to have somebody basically willing to eat our loss if this money loses money. So that was to Deutsche Bank, that was not a no, that was a financial structuring problem. So they went out and they went to USAID, which is the U.S. government's development agency that usually does grants, and they went to DFID, which is the U.K.'s development agency, and each of those two agencies agreed to put anchoring layers in this fund. One of them was an equity loss layer and one of them was a debt loss layer because there was both equity and debt layers in this fund. And so with that, Deutsche Bank was able to go out to 2 to 3 different kinds of commercial investors and get them to put in their money. They had one layer that was for banks, and they had another layer that was primarily for corporations who wanted to do good in the world but weren't sure how to do it, but said, we'd really like to see if we could get a 3 to 7% debt return out of this money. So they were able to knit that all together into one product, one fund. But all these people are in there with different needs and different potential rewards. And so this is what we saw happening over and over again as we looked at many of these funds. Yes, there are some straight venture capital funds in there that have no layers, but some of those deals that they're in are structured. And so what it showed to us was that in the impact space, you have more than one variable, right? So normally when you're doing structured finance, you have people who are interested in basically balancing out risk and return. And so, maybe you want, someone's interested in a high return, someone's in a low return, and you kind of balance it out. But you have another variable here, which is impact. So USAID and DFID are completely interested in helping poor people to run businesses and become self-sufficient. So they were willing to take a loss because they were actually leveraging a whole bunch of other capital that wouldn't go to the thing that they actually care about. They would have had to do that themselves through grants. But in this case, they were able to do a very small amount of grant money and have the rest of the market jump in. So that's a complete win-win for that investor who has that impact goal. And so part of the art that we saw of putting together really strong impact investing funds is realizing that there are different stakeholders in the marketplace who have different goals, and sometimes they care enough about impact to play with others in different ways. The real success story of that fund was that when the fund was done and the investors all got paid back what they expected except one layer who got a little bit lower but wasn't bothered by it, they were able to do a second fund without any of those loss layers in it. So they had basically proven to the commercial players that this was a commercial play, that they could trust, and that the risk was reduced.
And have you seen any funds with a retail layer for getting the average folks into impact investing?
Yes. So the most noteworthy example of what we call retail, which means basically a fund that is open to everyday investors as opposed to very, very wealthy ones, which is usually the restriction by the IRS, there are several now, but the core one that we had in our book was the Calvert Foundation, as I mentioned before. But Calvert has a note that you can invest as little as $20 if it's online at vested.org, or $1,000 if you do it through your broker. And that note is open to anyone on the planet. And they have actually registered in every state to be able to do that. They've gotten special dispensation from the SEC because they're a nonprofit fund. There's a whole bunch of things, a whole bunch of hoops that they had to go through 25 years ago to create this kind of novel product. As a result of that, they are able, and they are now doing really interesting things to engage new kinds of communities and individuals in the idea of impact investing. So, for example, they have a communities product now called Ours to Own, where, for example, in the city of Baltimore, they've gone out and they've created an investment fund that only invests in Baltimore, and then they can sell that as an investment for $20 and up to people who live in Baltimore who want to invest in their own community. It's really, really smart. And it takes this whole idea of impact investing out of this kind of wealthy elite thing and says, anybody who has $1 or anybody who has $20 can think about what do they want the impact of that dollar to be. Do you want it just to make you money, or do you want it to do something else on top of that? And I think that's extremely powerful.
It is. One of our newer partners at Lift Economy is Jenny Casson, who has been a big champion of direct public offerings. Is vested.org and the community investment note, is that different than a direct public offering, or how does that fit in?
I believe it is. I believe the note is, as I said, it's a registered product at the state level. So it is not there is no offering. It is registered at the state, and as long as their state registration is in good standing, you can buy it any time, and they sell it any time. The direct public offering, I know less about. Maybe you know some more about, but as I understand it, it's a one-time opening.
I think you're correct, and I should ask Jenny for more about that. Great. And, one of the other hats you wear is heading the Social Entrepreneurship Accelerator program at Duke. And one of the interesting things we're looking at Lyft is what are some of the needs or patterns that are arising from social entrepreneurs to get to the next stage. And I know at the Social Entrepreneurship Accelerator, you're looking at mid-stage companies. What are some patterns or needs you're seeing that are helping the companies you're working with get to the next level?
Oh, that's a great question. So we are thrilled to be working with USAID to basically scale the impact of global health entrepreneurs who are working with low to middle income populations in East Africa and India. So for those who may not be as familiar with those systems, healthcare is a largely government run and not necessarily all that well run system in many other countries, and there's been a kind of groundswell of new social entrepreneurs, both nonprofit and for-profit, stepping into the healthcare arena and trying things, right, and being a good kind of area of R&D for the field to say what are the different ways that we really can reduce AIDS levels or serve migrant workers or increase the health of new babies and new mothers. So we have been working with, as you said, mid-stage entrepreneurs, about 25 of them in these two countries. Our accelerator is very odd in that, unlike other accelerators, it is a 3-year program. So it's very long-term. We have a series of relationships that we take advantage of both at Duke and on the outside, both domestically and globally. So we work with the entrepreneurs to kind of figure out what is the path that they are on to scale their impact and grow, what are the needs that they have, and what are the problems that they need to solve. And we actually check in with them, every 4 to 6 weeks over 3 years. So it's a very high service model. What's been great for us as an academic institution is that working with a small collection of entrepreneurs that intensively has given us almost a lens into, kind of common things that happen again and again. So one of the things that we've seen is that talent and HR is a very big struggle for scaling ventures in the healthcare industry, especially the clinicians that they need to hire. So we have a subset of our entrepreneurs who are actually running clinics in low-income populations, and either in urban districts or in rural districts, and they it's very difficult for them to get the talent that they need at the time that they need it as they grow. Another one that has come up again and again is how they raise capital. And what's been interesting about that is that many of these, as we said, they're mid-stage. Many of them, when we start working with them, they have about $1 million in revenue if they're for-profits, and the nonprofits are often much larger. They are familiar with how to successfully raise grants. They are familiar with how to get things off the ground, but they maybe have not had as much direct contact with the investment community. So we've been kind of an intermediary in those conversations with them, and we saw a bunch of patterns emerging where the norms that you have to excel at to get grants are so very different from what investors expect. And so one of the things that we've actually done in the past few months that I'm really excited about is we've put together a series of online tools based on the lessons from this cohort of entrepreneurs that we're making available to all impact entrepreneurs around the globe about how to be smart about raising impact investing capital. So very much focused on, what are the mistakes that people make over and over? What's the homework that you need to do before you talk to an investor? How do you interpret what an investor tells you and manage that relationship? And we did a beta test in the fall. It's called Smart Impact Capital, and we had about 250 people in 10 countries testing it, and it was very, very well received. So we're building out the rest of 9 modules on this now, and are going to be offering them shortly more publicly.
That's incredibly exciting. What are for the listeners? What are maybe 2 or 3 top tips that you give to those people seeking capital?
Oh, there are so many. So I have some really funny ones, but let me try to stick to some serious ones. One is this is embarrassingly true. I cannot tell you how many times I have talked to an entrepreneur who is raising money, and I say, how much money do you need? And they tell me a number, and then I say, can you back that up? Can you show me how your model is going to work? And they say, I don't really understand the model. Like, they wouldn't say that to an investor, but they say it to, I don't really understand it. I can walk you through it a little bit, but I don't really, so I hired someone, or I have a CFO who did it, but I don't really understand it. And I'm like, you don't need to sit down with the investor then yet, because you're going to flub that meeting. Right? That is, so the most common question we get from entrepreneurs is, who do I meet with? Who do you know? Connect me. And the most common response I have is, show me your model first, because you might get one chance with that entrepreneur to make a good impression, and I don't want you to blow it. So that's a really basic one. So one of our modules is actually about how do you use a spreadsheet to create a finance gap projection, and how do you model different kinds of capital to go in it. So it's very, very practical. Another mistake that we see is the investor has a contact with the entrepreneur, reads the plan, comes back and says, we're not interested. And the entrepreneur thinks that they're done. And one of the things that we try to get them to figure out is that a complete no, or is that a no with conditions? And can you figure out what the conditions are? And most investors will tell you what those conditions are if you ask. And so, realizing it's not a grant program, they're not turning you down forever from that round of RFPs. This is a relationship. And every interaction that you have with that investor is towards a possible relationship. We also separate what we call knockout factors from conditional factors. And that there's a certain amount of triage that you need to do with your list of investors to figure out whether they're rejecting you for a factor that is never going to change versus a factor that you can influence. And so we give people advice about how to do that.
And is there a list of, I don't think there exists, perhaps you know something more than I do, is there a list of investors that like to invest in these companies, or is that sort of something that needs to be developed in the marketplace? Or
Well, there are several, and they are not particularly entrepreneur friendly at the moment. So I mentioned Impact Base earlier in the podcast, which is a online database that the GIN runs. It is only open to accredited investors. So it's a list for investors, not for entrepreneurs. There are several sites that have popped up online that I think are excellent, and they are starting to grow in terms of the information that they have. Enable Impact is an excellent one. Impact Alpha has another one that's excellent. And then we actually have our own database, particularly for entrepreneurs interested in global health, we did a landscape study as part of our accelerator so that we could understand the breadth and depth of investors interested in global health investing. And we actually have a global health advisory board that meets quarterly of those investors so that we can bring deals to them regularly. So we are trying to create that marketplace, not just inform people about it.
Got it. So let's see. So who else? What else are you most excited about for 2016? Is there anything that stands out as, oh, this is going to be a big development that you're really looking forward to?
There are some trends I'm seeing that I'm excited by. I'm very excited in the broad impact investing space. I'm excited by some of the new wealth that is stepping into the space, and I think it is, both an opportunity and a challenge for some of the newer tech entrepreneurs and others. I think there's some great ground that's been plowed by, Jeff Skoll and Pierre Omidyar and Bill Gates and Steve and Gene Case in terms of how do you navigate and migrate from your entrepreneurial career to a career of impact. And I think just the announcement a few months ago of Mark Zuckerberg's commitment to putting, his and his wife's commitment to putting $44 billion into the impact world is quite exciting. I actually know for a fact that that's the tip of the iceberg of what's coming in terms of some of the Giving Pledge billionaires who are very interested in impact investing. So, there's going to be a lot of new money in this space learning together. There are new networks being formed of some of them where they're sharing investments. There are already networks of individual philanthropists and family offices who are looking at how do you think about impact across your entire portfolio. Tonic runs something called the 100% Club of people who are doing just that. I think there's going to be so much learning over the next few years about how to engage everyday people who think that their money is basically just sitting in some account somewhere and thinking about, well, wait a minute, what could I do that's aligned with my values? And I just think I think we're going to find, whether it's the next year or the next 5 years, we're going to be in a completely different place 5 years from now in terms of everyday people's understanding of what the power that they have with their dollars.
Right. Is there anyone else you're watching or who's inspiring you? Like, who's the most inspirational person or organization in this space that you're really looking towards?
Oh, that's a really good question. There are all sorts of people that inspire me every day. I have to say what really inspires me is when people come together across different sectors and find ways to do things together that they couldn't do alone. Right. So it's much less an individual. I mean, I could name some individuals that inspire me, but to me, the real meaty, kind of exciting thing that's going on right now is when people come together to do collaborative things. Whether that's, some of the things that Living Cities is able to do, which is a collaboration of foundations, or whether it's the G8 task force or the National Advisory Board, which came together a few years ago and managed to have two very significant policy changes, just in a very short time that have basically unlocked obstacles that existed both for foundations and for pension funds to do impact investing, or whether it's entrepreneurs coming together and realizing that to really have an impact on a population, you need a bunch of different points of leverage, and when they work together to do that, which some of our seed entrepreneurs are doing, it's really exciting.
Great, Cathy. And so where can people learn more about your work? Website? I know you have an interesting email program currently going on, but perhaps you could give people some next step for resources.
Yeah, we got lots of resources. That's an easy one. So we have a ton of stuff at our Case I3 website, which is www.casei3.org. We have on there something called the Case I3 100, which is 100 of our favorite reads and platforms and databases on impact investing. So Enable Impact is in there if you're an entrepreneur, many of the top reports, and also links to things like B Lab and B Corporations and Benefit Corporations. So all of the main databases in the field are on that list. Highly recommend that. We also have a fairly active Twitter feed. You can find me at Cathy HC. And then we have a weekly newsletter. So anybody who's interested in kind of getting, a once a week digest of what's going on in this field, we encourage you to subscribe to that, and that you can find that on Twitter through the hashtag #OnImpact, and it's free.
Next Economy Now is a production of Lift Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.